Okay, perfect. So let's start. Thank you very much and welcome to a new edition of Into the Blog, a webinar series where we try to discuss some of the newest trends related to crypto asset and market intelligence analytics. Today, it should be a super exciting webinar because we're gonna go deeper into machine learning techniques for crypto asset analysis. And I'm really gonna focus on the ones that we have tried and experimented with. I'm not gonna talk too much theory. So this webinar is a practical look into machine learning techniques that work for crypto assets, and we're going to explore a little bit of some advanced ideas at the very end. A couple of logistics things like other webinars. If you have any questions, feel free to use the Q&A panel. I'm gonna be stopping multiple times throughout the session to take questions and to answer questions. So my name is Jesus Rodriguez. I'm the co-founder and CEO and CTO of Into the Blog. Have had a long history as a technologies in from building cloud systems at Microsoft to quant systems in Wall Street. I'm an artificial intelligence geek. I teach Apply AI at Columbia University, and I'm super passionate about what we're doing in Into the Blog that sits at the intersection of machine learning and crypto assets. So what are we going to talk about today? So we're going to do a quick, very basic intro just to set the context of machine learning, and then we're going to dive right into contextualizing the machine learning for crypto assets. And then we're going to talk about 4 scenarios that are super challenging that we have tackled. And then at the very end, we're going to talk about some of the more advanced techniques and ideas that we're seeing in machine learning research that could be very applicable to crypto assets. As I said, throughout the presentation, feel free to ask questions, and we're going to keep it very dynamic. So there is a ton of hype around machine learning. One of my partners was telling me when he was reviewing the PowerPoint that I forgot to address a part about how to do this without going crazy. Well, the going crazy part is that there is a ton of the deep learning, machine learning space is completely overhyped. A joke that we typically tell in the space is like this: if you're in front of investors, you typically talk about artificial intelligence because that drives attention from an investor perspective. If you're hiring engineers, you talk about machine learning because that's what they get excited about. But at the end, most of the things that you implement are these basic statistical models that are based on linear regression, on the linear regression school, and that's probably true. So even though we're living in the golden era of machine learning and deep learning, a lot of the research from the 1960s, 60s, 70s, 80s is now possible. We're not applying a lot of that because of the practical scenarios are still being addressed with very simplistic techniques. So a typical distinction that you need to make, particularly when applied to crypto, is what is machine learning just against the traditional statistical models. There are ways to think about this. But traditionally, when you think about statistical models, are programs that formalize a relationship between different variables. So it infers those relationships and derives some mathematical equation that links those variables. And machine learning programs are things that can actually learn and infer patterns from the data. But a key difference is that machine learning programs actually learn. So they get better over time, where statistical models are more constant and more steady in terms of their output. So something that with more data, with more execution, learns and improves or not is a machine. It can be considered a machine learning program. Another thing that you're typically going to hear a lot is these three buckets of what is artificial intelligence, what is machine learning, and what is deep learning. And this gets really confusing in the market. So you should see AI as a superset of everything, and AI is our quest to emulate the cognitive functions of the human brain and human cognition, and that has all sorts of different disciplines. Machine learning being sort of the practical application of AI today, in which we're building programs that can literally learn from different data sets and execution. And deep learning is sort of a new trend that has been in the work for 20 years. It's a specific discipline of machine learning that is really focused on neural networks and deep neural networks. This is a discipline. When you think about when you learn about the history of machine learning, at some point, the path of the space completely, it was divided between two groups. The group that believed that emulating the cognition of the brain was a path to follow, and everybody else. And those people stayed for 20 years on that quest, and finally, and it was failure after failure after failure, and finally compute evolved to the point with the emergence of the GPUs and things like that, it evolved to the point that these complex neural networks that were all theoretical, they became practical, and we could actually implement them. And that opened up the entire space to that is what we call deep learning today. So deep learning is a subset of machine learning that is really focused on neural networks and deep neural networks. So when you think about crypto, 80% of what you're going to do is traditional machine learning in terms of the scenarios that we have today. And there is a tiny little bit that you can do with deep learning. And that's a way to think about it in today's market with today's technology. So a lot of what you're going to do is traditional ML. And there's some scenarios, and I'm going to show you a couple, that could be tackled with more advanced deep neural networks. And that's just a fact with the technology that we have today. So another question that you need to answer is, what are the types of machine learning scenarios? Traditional theory shows you just two groups. Supervised learning, these are models that you train with data. Think about a t-shirt, right? You train a prediction model with different price scenarios, and then the model learned, and it can output specific predictions. And that's a type of model that requires that you have labeled data to train the model and things like that. And then the second school of thought is unsupervised learning, that essentially are models that learn directly from the data set without any training. They try to infer patterns and make decisions around the data set. So a way to contextualize this in history, think about that the future of AI and machine learning is going to be unsupervised, but today supervised learning rules. Like by far, the bulk of the models that we apply today require supervision, but the quest is to make those models independent. So as AI continue evolving, we should see that pendulum shift towards unsupervised model. Now, this is a very simplistic view of the space. Reality is way different. So when you think about machine learning models from the practical standpoint, it expands way beyond supervised and unsupervised. There is this technique called semi-supervised learning that I'm going to tell you a little bit more at the very end, that fits between the two, that allows you to do training with very specific, very small data set. There is the school of reinforcement learning that has been pioneered by companies at DeepMind, that now are a subsidiary of Alphabet, the guys behind AlphaGo, that essentially are models that learn by trial and error. This is a technology behind self-driving cars and things like that. And from there on, you have a complete plethora of models that you can apply. So it goes way beyond supervised and unsupervised learning in today's world. So what about crypto assets? What about machine learning for crypto assets? Why is this important? So when you think about the crypto space, a lot of the things that we can do with ML are the same things that that quants were doing in traditional capital markets. So if you look at data feeds like order books or futures or derivatives, you can apply models to that. But with crypto, we have a different data set that is the blockchains, right? That provide a completely new universe of data at our disposal, and that's something that can also be applied in AI models. So if you combine the traditional data sets from exchange order books, derivative, and things like that with blockchain data sets and apply data science to that, you can come up with all sorts of interesting insights that are very, very hard to emulate. However, there are plenty of challenges. This is far from being trivial. So one of those challenges is the data sets are very heterogeneous. I mean, think about Something like an order book in an exchange is completely time series and very structured, right? You have price and time and other things, and bid and ask and other things. Blockchains are hierarchies of a structure. Blocks link in a hierarchy. And then when you get data from Twitter, Telegram, and things like that, it's completely unstructured, is text. So the time series data is very prone to traditional machine learning. Hierarchical data is in between machine learning and deep learning. Unstructured data sets like text are a complete domain of deep learning. So the space that analyze text and images and things like that, those are deep neural network models. And that's sort of the way you should think about it. Now, I mean, we can talk generically about a bunch of dreams and scenarios, or we can, but I'll prefer to deep dive into specific scenarios that we think are killer in the crypto space, that we think are super valuable, and that we actually work on them. And we can talk about others that we're thinking about in the futures, but at least in the context of this webinar, I would like to focus on practical lessons and practical models that we have tackled in the Into the Block platform. So, and I'm gonna pick 4 of them. So blockchain de-anonymization, I believe, and I've been on record saying this, that is one of the biggest challenges in order to achieve relevant market intel. And we're gonna talk about that. Looking at the blockchain to understand the profiles of individual investors is also a machine learning problem. Of course, no machine learning presentation in capital markets is complete without talking about price predictions. But beyond getting to price predictions, it's also helpful to understand what factors could lead to meaningful predictions. So those are 4 problems that we have tackled Into the Block, and we have a lot of miles into and a lot of failures, right? Trying to solve these things. And I would like to expand on those a little bit. So let's talk about de-anonymization. So one of the challenges that we have with today's technology is blockchains are semi-anonymous data sets. So it's impossible to differentiate an address that belongs to an individual wallet, that belongs to an exchange, that belongs to a miner, that belongs to an OTC desk. And without having that type of intelligence, the analytics that you can produce are very limited. So if I don't know that addresses are exchanges, I cannot produce intel about exchanges. To me, every address is the same. And then when you do an address graph, you're counting everyone the same, which is absolutely ridiculous. So why is this a machine learning problem? Well, imagine that you need to actually train a model in the behavior of a specific actors, and those models need to learn that behavior and go out there and identify new ones. How do you tackle that? Well, here's an example. Here's one that worked for us. So one problem that we focused on was to classify exchanges looking at the blockchain. How did we do this? We trained a series of machine learning classifiers on exchanges, specifically on the Ethereum blockchain, and using a large collection of factors, like over 50, the models were able to generalize that knowledge onto other blockchains. So essentially, the problem is this: I give you a series of addresses, and you're going to tell me exchange or not. So it's a classification problem. From the many techniques in the market, this technique called decision trees, in which you look at a data set and you infer hierarchical rules based on that data set. So think about a rule could be the address is holding over $1 million. Then the second level could be, okay, it's holding over $1 million for over a year. Then you can break down the path, right, like that onto all sorts of factors. And we think this model is very simple to do and actually very effective. How does that look like? Well, I mean, this is a result of some of our classifier. Where you're looking on the left is Binance, where you're looking on the right is Polonix. Some of those models have been able to really understand the behavior of exchanges from predicting hot wallets. Look at the legend on both charts. It's going to tell you the green dots are hot wallets with certain percentage of certainty, deposit addresses, withdrawal addresses, cold wallets in an exchanges, and essentially infer the entire topology of an exchange. Why is this important? Imagine that with this type of analysis, you can monitor money coming in and out of exchanges. You can monitor money being held in inventory on different exchanges. You can identify different risk factors and things like that. And this is a machine learning problem that we have tackled and we believe successfully solved, at least for now. And it's being completely addressed using ML techniques. So a second problem that I wanted to cover is investor profiling. The blockchain gives us a window of opportunity to understand the individual behavior of investors, which is something we cannot do in any other asset class. So blockchains are not complete. They're missing information that is being kept on exchanges, but they're a statistically relevant representation of what happened, of the behavior of a crypto asset. So imagine that looking at the blockchain activity, number of transfers, number of payments, things like that, you can identify, you can qualify those investors into different buckets. You can qualify it from a financial standpoint, from a psychological standpoint, from a behavioral standpoint, and try to derive better intelligence from that. Why is this a machine learning problem? Well, simply because the models are going to be presented with a blockchain data set, and they, looking at that, they need to infer behavioral patterns and drive a specific conclusion. So this is not something that you can do with plain statistics. So a technique that is very common and that we use in this case for this specific problem is clustering. So clustering is one of the simplest form of unsupervised learning that essentially looks at a data set and divides it into different groups based on proximity. In this case, we're looking at a collection of addresses and transactions and inferring cluster. I mean, it's way more complex than that. I'm obviously oversimplifying the logic of the model, but essentially inferring clusters based on the financial position of investors. What is the result of this? Well, there are many. If you go into a block platform, there are about 4 or 5 models that play with this technique. One of them that we call in and out of the money about the current price gives you, take the current price and go 15% plus, 15% minus, and the model is going to identify 10 clusters and group of investors based on their position. So this model is typically used to understand better levels of support and resistance. This chart is from a couple of weeks back, but imagine that it's showing you that there is about 400,000 Bitcoin investors or addresses that are holding Bitcoin at around 10,580,000. So if the price of Bitcoin went up to those levels, you will see some activity. The same with this cluster of 733,000 addresses. And this is a result. This is a type of intel you can get by applying clustering to this. So factor identification. What moved the price? What is relevant? So in traditional finance, in traditional quant finance, there is an entire theory, the FAMA French factor model that is going from 2 to 3 to 5 factors, and you have factors and momentum, value, carry, and others. None of that really exists in crypto, particularly because we're talking about a single asset class and one that is new. It's not that it doesn't exist. They do exist. It's just that it hasn't been formulated what are meaningful momentum factors or value factors or things like that with enough statistical rigor. So what is the problem here? We're trying to look at all these data sets and infer things that we think are relevant for price movements. Why is this a machine learning problem? Is because you need to compute price movements over time and learn correlations between different factors that could lead to a price movement. The technique for this, honestly, is the simplest technique of all, linear regressions, which is honestly what most quant models in the market use, different layers of linear regression. Imagine that we build this matrix with price movements and a lot of different factors that we think make sense, and the model is going to go back and infer relationships and correlations around that. What is the result of that? Well, if you go into the block platform, the first thing that you're going to see is all these dials that give you a bullish or bearish momentum based on price, and they hit about 70% of the time in accuracy. And those models are based on they're built linear regressing a single factor, a single thing, like the number of large transactions or the behavior of the network, or the behavior of whales, or things like that, and then we discard all sorts of other things that haven't shown any relevance. And obviously, we're still missing another hundreds that are showing relevance, but we're not seeing them yet. So this is another machine learning scenario that is definitely addressable with today's technology. So the last one I want to talk about is price predictions, which is obviously the crown jewel of any capital market capital market model when thinking about machine learning. So the problem here is predicting the price based on something. So why is this a machine learning problem? We're talking about predictions. So enough said. We need to learn the behavior of a crypto asset over time and think about predictions. So there are many ways to think about predictions. There are many ways to tackle it. Most of them are going to be either unsuccessful or successful for a specific market moment and conditions. And when the market shifts, those predictions are going to stop being effective. So it's important to realize that no prediction model works all the time for all market conditions. That's just impossible. So a traditional way in which quants have thought about price predictions is using linear regression decision trees models. There is a new school of thought, fairly new, like maybe 2 years old, that is tackling this type of prediction models with deep neural networks. Extremely complex, right? But also the theory is that these sophisticated models can see things in order books and futures and price data sets that simpler models miss because of the complexity of the different layers. So we have been working on this very hard in terms of coming up with collections of models that can predict effectively. One idea that we like a lot is this one that combines two techniques, one called convolutional neural networks and another called long short-term memory. Network, think about something that the input is the order book from a ton of exchanges, at least the ones that we know are not corrupted. And the first layer that is going to be the CNN layer, essentially is going to break down hundreds of thousands of potential factors that can influence those prices. No factors that we know, like all sorts of statistical variations that are hard to understand. And then it's going to discriminate and come up with the ones that it feels are more relevant. And then the long short-term memory tries to focus those predictions and focus the efficacy of those factors in a specific window of time. I mean, it's really complex. And then the final layer of the LSTM sort of aggregate all those predictions into a single output. This is complex. I mean, I try to explain it the best way I can. But with that type of with those type of models, we have been able to achieve very high levels of accuracy. This is a live test from very recently. Look at the time frame, and those models are hitting about 70%. That's the subject of the next webinar, so I'm not going to unveil anything for you, but our data science team has been going crazy about this stuff, and you can see that some of them hit over 90% accuracy during a specific days. So predictions are really hard, but crypto assets are predictable. Like any other asset class, they're not predictable all the time. They're not predictable for all market conditions, but there are a specific market momentums in which a specific prediction models are gonna be very effective. So everything I show you so far is more on it is novel, but it's also very well established machine learning techniques and deep learning techniques. Even the last one of CNNs and LSTMs, in the space of deep learning, those are very well techniques. So there are a few new techniques and methods that we're super excited about. Not that we have had any particular success, but are things that we're trying and are more on the sort of cutting edge. And I just want to mention 3 of them real quick, just to put it in your radar. One is this thing called semi-supervised learning. So we talk about supervised learning, you train and it outputs things. Unsupervised learning, you don't need to train it and it infers data. So one of the problems with supervised learning, it does require a ton of label data, and label data is hard to get and it's expensive to get. So a few people, Google has been very, one of the pioneers behind this technique. They created something in between called semi-supervised learning that are models that can train with a very small subset of data. So essentially, you give it a data set of labeled data and unlabeled data, and it's able to sort of find clusters of proximity in the unlabeled data that can also be used to train the model. So Google uses this a lot, and there are some public studies about this. This type of models are very good at training machine learning models with very small data set. Why is this important in crypto? Because there's no labeled data. So if you're trying to train something that classifies exchanges like we did, what data sets you're gonna find that have exchanges or miners or OTC desks classified that you can use to train a model and maintain that over time. So if you can figure out a way to do it with semi-supervised learning with a smaller data set, it's super effective. Another technique is, I mean, this is sort of one of the holy grails of artificial intelligence and machine learning. Is called transfer learning. So most machine learning models today are very good at doing one thing, like one very specific domain-specific task. And it's very hard to take that model and use it for other tasks. So that's completely the opposite of how the human brain works, right? We are masters at reusing the skills. We're learning a new thing and we draw analogies for things that we know. So transfer learning tries to do that, tries to take models that already know how to do one thing, like predicting price, or let's say classifying exchanges, and use that knowledge to classify something else, right? And this is definitely doable. I mean, it's been done in other subjects. In crypto, obviously, it hasn't been tried, but this is an area that we're keeping an eye on. And another one that is the popular name out there is AutoML. The official name is called Neural Architecture Search. This is it tries to make the creation of machine learning models a machine learning problem. So one of the challenges as machine learning practitioners that we have is that we are at the mercy of data scientists. So we have a problem. Let's say we're trying to do price prediction, and this data scientist will say, oh, that can be solved with time series forecasting. And another one will say, this can be solved with CNN LSTM. And okay, it's a deep neural network, but it's 100 layers, it's 50 layers, it's 80 layers, how wide? So it's very subjective and a lot of trial and error. So some people came up with the idea, again, Google was one of the pioneers on this. What if you create, make the modeling of a machine learning model a machine learning problem, and then you have this other architecture that can test hundreds and hundreds and hundreds of machine learning models at the same time and come up with the best ones for your problem. We have used this, actually, the exchange classifier was a result of using neural architecture search, and some results are promising. Sometimes you come up with some very stupid things that don't make any sense. But in some cases, they have proven to be effective. And everybody's behind this. If you're using Google machine learning stacks, they call AutoML. Azure and Microsoft has the same. So does Amazon. So there is a lot of technologies for this. So that's actually all I got. I'm going to go into questions because we have a few. But essentially, to summarize this thing, so machine learning crypto is going to be an asset class driven by machine learning. There is no reason, it's all digital and the data is there. So machine learning is going to play a pivotal role in developing market intelligence models for crypto. Blockchain data sets are extremely unique for crypto and something that could influence the level of market intel that we get today. And one of the biggest challenges, obviously, is the anonymous characteristics of the blockchain. Speaking of that thing, right, the next webinar, I'm going to go into Q&A, is about price predictions. We already did a webinar about predictions in which we talk about the theoretical aspects of it, the challenges, what we should look for, the machine learning techniques that we thought would work. In this one, we're going to show you stuff working. So you should not miss this. After this webinar, you need to go and register. So we're going to show you different machine learning models that are predicting, the ones that are doing well, the ones that are doing badly, what works, what doesn't, and some of the challenges that we experience. So we're giving ourselves 3 weeks because we're still in the middle of it, but this is going to be super exciting. So you have to go and register after this webinar. The link is in the chat. And there are no prediction models for crypto assets out there. So this is going to be a first in the market. And we're going to show it live, even if the stuff is not working properly. So we have one question that it said, how power hungry are the analytics tools you're describing? Yes, very. So some of this is very hard to do. So to give you an idea, some of the prediction models, we went back and trained the models in every trade on different exchange in 6 years, minute by minute. So that's insane. That consumes a tremendous amount of computation. The exchange classifiers literally need to soak in an entire blockchain and classify it. So hundreds of gigs or terabyte, hundreds of gigs of data or a terabyte of data. So it's very hard, and then you need to do it. You need to do it over time. There is another question from Joshua. What traditional financial models are you using, for example, portfolio theory for ML? Yeah, so we don't manage or recommend portfolios. Markowitz theory and the Sharpe ratios and all that, they have a role in crypto. The problem that you have with those things, at least from this is putting my quant hat on, is that you're in a single asset class. So a lot of the things that you try to do with traditional Markowitz portfolio theory of minimizing risk and all that is tricky as hell if you're living in a single asset class. So that's one of the, I think portfolio theory for this thing has to be sort of readapted, or it works better in the context of a portfolio that combines crypto with other asset classes. I hope that answered your questions. I don't know if there are any questions. Okay, so that's my contact info. Send me a note to my email or through my Medium. Oh, there are more questions, a lot of more questions. So can the same process be used for on-chain marketing analytics, identify user behavior? Yeah, many of these techniques are applicable to those scenarios. So the same type of thing that you use to classify exchanges could be extrapolated, for instance, for things for determining if a user is making payments or transfers or things like that, which are important in marketing. More questions. Hang on. What about to use trending time series for Reddit or Twitter? Interesting. So I don't know. I don't think it works, but it could. I mean, there have been some research papers out there that claim to have had some success measuring Reddit activity and Twitter. I think that's very simplistic, but it could work. I mean, ultimately, we have social analytics in the platform, so there is a portion of the investor base that believe that that's relevant. I think what you can do with Twitter in areas like sentiment are interesting, or things like topics that don't really work very well. Social media activity as a reflection of price. Sometimes it's more like a lagging indicator, their price movement and the activity triggers. So it's hard to quantify, and it's definitely very vulnerable to manipulations. There is another question. Have your API for the data or just shard? Yeah, we do have an API, Jesus. So send me a note to that email, and I'll put you in touch with our team. Do you have any tips of resources for learning ML? Gee, I mean, this is a hard one. So there are plenty. So I think if you go to the Google AI University, is one of the best ones I've seen. There is Andrew Ng, one of the founders of deep learning, and the founder of Coursera, actually has a ton of deep learning courses on Coursera, and there is a ton of books. Is there any collaboration with Chainalysis or Elliptic in those models? Do you see? Yeah, no. So sadly we had to go heavy on the machine learning side because we couldn't leverage labeled data sets from companies like Chainalysis. We try, they have their business model for this, and we're respectful of it. We do think that at this point, on the long term, machine learning models are going to be more effective at labeling data than humans in this case, and we're already seeing that. So initially, it would have been great to train our models with that data. I'm not sure we're gonna need it too much longer though. I think the models are getting smarter, and eventually it's better to rely on ML to classify and label data than on humans putting subjective opinions. What do you use as benchmark to test the success or calculate the alpha? Oh, many. So it depends on the model. So there are plenty of techniques that we use, from measuring bias, variances, all sorts of things. If you like a specific technology that we like for this, because this type of thing of hyperparameter optimization and measuring effectiveness and all that in terms of tooling hasn't been developed too much. In the market, there is a little company called Weights and Bias, WMB, that is being used by some of the top AI research labs in the world, OpenAI, DeepMind, they all use these guys. We have been using the tool for our prediction model, and it's fascinating because you can actually run a ton of experiments at the same time, compute the results. It's very visual. So it's great. There is another one called TigerML that is good. They're tooling in AWS SageMaker, Azure, but it's not as good as these guys. So Weights and Biases and TigerML, those two are extremely good. And if you have more questions on that, our data science team are probably more up to date with this type of stuff. How to use different time windows or stations for different time patterns on the prediction? What a great question. So here's the well, there are like 3 questions there. So thank you for the question, Alan. This is awesome. So first question: if you're building a prediction model, what's an effective time window? I don't know, but I'll tell you that we try minute by minute, and if fail, try hour by hour is good. On the longer time horizon is bad or riskier, more vulnerable to variations, but definitely possible. But one thing that is super interesting, imagine that you take the snapshot of an order book or a futures contract trading or things like that, and you just partition into multiple quantiles to train your model. That's a technique, and to a lot of them, right? That's a technique that we find very effective. The other question is, can be useful, can ensemble models work? So ensemble models are this technique that is essentially combines multiple machine learning models into a single model. And the theory is that in the long haul, the combination of models beats the best model in the group. Absolutely. So our classifiers are ensemble of classifiers, not one. I published an article based on this. No single classifier was good enough, and our prediction models are the same. So ensemble techniques for this, they're hard to build, but definitely effective. Can you repeat the name of the company? Sure. I mean, it's into the blog and it's there in the slide deck. I guess the link to the next webinar is on the chat window. So guys, please raise your predictions. It's gonna be awesome. It's gonna make for a good debate. And I hope to get your feedback. So thank you very much for joining this webinar and for all the awesome questions. Send us your feedback, sign up for Into the Blog. There is a ton of data science insights in the platform. So play with it and send us your feedback. And I hope to see you in the next edition of the Into the Blog webinars. Goodbye.